Today, I'm happy to welcome back Frank Seneco from Seneco Associates to talk more about some additional advanced planning opportunities around insurance for successful families and business owners. So excited to have him back. If you missed the last episode, we went deep on benefit focus, defined benefit plans, and some of the unique features that make them a little bit different from traditional defined benefit plans and other retirement plans like 401ks and some of the ways that we can utilize life insurance inside of those to really enhance the benefits you can provide to you as an owner or to your employees. But today, we're going to talk about a different topic. We're going to focus a little bit today on private placement life insurance. And so, in general, I think people have heard of life insurance and are familiar with it in general, but there's some important differences with private placement life insurance that make it unique. And so, Frank, why don't you just give me a high-level primer, walk me through what private placement life insurance is all about.
Sure. Thank you, Homer. It's very nice to be back here with you.
Yeah.
Private placement life insurance, it's also known as PPLI, is a version of a life insurance contract that is used by high net worth and ultra high net worth families. It also comes in the version of an annuity, so private placement variable annuity, or also known as PPVA. But to start on focusing on the life insurance side, as I mentioned, this is a technique that's been being used since the late 80s here in the US and been used around the world for just decades, where you have ultra high net worth families have the ability to have customized investment portfolios run inside of a life insurance or an annuity contract and take advantage of the tax benefits afforded to either the life insurance or the annuity.
And what types of investments? So you say, take advantage of the investment opportunities. What kind of investments are different inside of a private placement, or what could be different inside of a private placement life insurance or annuity versus a traditional life insurance policy or annuity?
Well, what you have is, and there is a threshold to get into one of these, and we'll cover that in a moment. But it's really, you can have the ability to have, you can pick an investment manager who can run a discretionary portfolio. You can give them an investment mandate. Could be something like, growth opportunities, private equity, various types of investment options that you can have a manager look to invest in inside of the policy. The big thing here in the US, as I mentioned, these have been being used around the world for years and for decades here in the US, but it's really the policy owner or the insured cannot tell you as the investment manager to buy a specific investment or sell a specific investment. It really has to be discretionary. So you have the ability, you could have hedge funds, VC funds, different types, could even have a real estate sprinkled in there, but it's different than what's available on a traditional or retail-based policy. It's really a customized investment portfolio or option, and that you can also change your manager as you go along with the policy.
Got it. So unlike traditional life insurance, where you have what we call sub accounts or like the mutual funds that are available within the life insurance policy, with private placement, your advisor that you select really has the ability to go out and anything that would qualify within the type of typical investments, mutual funds, ETFs, private equity, venture capital, hedge funds that you mentioned. So a lot more wide range of investment options available as long as you follow the rules that you mentioned in terms of having a discretionary manager do the investment portfolio for you.
Yes, and we've been working in this space for a very long time. And exactly as you mentioned, it's follow the rules.
Yep.
And you have something that is a fantastic opportunity that has been being used by some of the very wealthy for years, where you just want to stay within the guidelines to be compliant. I mean, what you have here, so if you really think about it, you've got a wholesale-based insurance chassis. Let's talk about the life insurance version. And the annuity is also wholesale-based. So it's really a fee-based life insurance contract. You don't have any huge upfront commissions or loads associated with it. There's no back-end surrender charges per se, so the client can get out of it subject to the liquidity of the underlying investment. So monies that grow inside of the policy is the cash value, grow tax deferred. If it's structured properly, we can take out those deferred gains over the client's lifetime and they can have access to them without triggering taxation. So tax-free withdrawals and loans is what we can access. Upon the client's passing away, all of those deferred gains, whether they were left in the policy or taken out on a policy loan, will go away. So in essence, you get a step up in basis. And all of this with a customized investment portfolio.
So pretty powerful. You get tax deferred, effectively tax-free growth of the policy if you structure it correctly, tax-free access to withdrawals if, again, structured correctly, use it correctly, and then your family receives the ultimate life insurance benefit tax-free. So pretty powerful. So, give me an idea of the ideal candidate or who would qualify to be considering this type of private placement life insurance.
Sure. I mean, this is, as I mentioned, it's been around for years, but for a client to qualify to get into this, because it is a private placement, you have to qualify as an accredited investor and a qualified purchaser. So the qualified purchaser definition being the higher of the 5 million or more of investable assets. And you should qualify as the accredited investor if you qualify as a qualified purchaser. But it's really a client at that threshold, and they're looking to commit to 5 million or more of premium going into one of these type of vehicles. So this is not for the client who wants to save 25, 50,000 a year into a policy. This is the client who wants to put in 5, 10, 15, 25, $100 million of an investment portfolio or cash to be invested in it inside of the policy. And they're usually tied to some kind of a multi-generational trust structure.
Got it. So, when I hear that, or if a client hears that, putting away 5, 10, 15, 25 million plus into a life insurance policy, some people get the idea that, gosh, if it goes inside of there, depending on the type of planning they've done in the past, I lose access to those funds. So why, even though there's some nice tax benefits to this, how do I get access to this if I want to over time, assuming, we put it in there, we have a long-term goal and have some time frame to let the policy grow. But how do I get some of this money out to take advantage of this tax deferral and tax-free withdrawal?
Well, that's a great question. But before I go into how you get money out, as you mentioned, clients are looking at this, and the typical transaction is probably 10 million plus that's going into this. And a client will come and say, well, gee, I'm putting my money with an insurance company. This is a specialized product. Here in the US, or even if we're doing them offshore, it's part of an insurance company's separate account. So it is not subject to the claims and creditors of the insurance company. So clients are really looking at this. Let's use the example of $10 million goes into a policy, and I have a life insurance benefit on top of that because it's a life insurance contract. If anything were to happen with the insurance company, that cash value is protected because, again, it's part of the insurance company's separate account. So that's why you have these ultra high net worth families utilizing this type of a strategy, because they're not concerned that they're giving their money to the insurance company. Secondly, the insurance death benefit is going to be reinsured with all of the big reinsurance companies that the retail insurers use. So you've got companies like Swiss Re, Munich Re, just to name a few that are backing this up for the death benefit side. The other part of it, as you mentioned, how do I get access? Well, that goes back to the design of the policy. And I mentioned earlier in the tax benefits through withdrawals and loans. If we, design the policy, let's say we're doing something here in the United States, you can have what's called a modified endowment contract or a non-modified endowment contract when it's a life insurance policy. And that goes to how we design or fund the policy. So under a modified endowment contract is typically one contribution. We put in $10 million. It's going to grow tax deferred. And upon the client passing, it's all income tax free. If it's put into a trust, it's going to also be estate tax free if it's done properly. The issue with a modified endowment is as policy owner, I can access funds, but I will trigger some taxation on the gain as the same as with an annuity. And if it's done before age 59 and a half, we have a 10% penalty. If I do it as a non-modified endowment contract, a non-MEC as we call it, we'll put the premiums in typically from 2 to 4 years into the policy. With that, again, I have all of that tax deferred growth in the policy. Upon passing, it's income tax free. And as I mentioned, if done properly, estate tax free. But as a non-modified endowment policy, we can take a withdrawal of the client's basis, that's the money going in premium in the contract, and then also borrow out on top of that after basis any of the gains, and there's no taxation on it. So overall, it was a little bit of a long-winded explanation, and I don't want to get too technical, but it actually goes back to the design of the policy. Your money is always accessible to you. The design of the policy, whether it's a one premium going in and it's the modified endowment, or the multiple premiums and the non-modified endowment, and then we can just access tax-free loans.
Great. So bottom line, it sounds like to me on this is, a client has a life insurance need, so there's some benefits to having a life insurance policy in general. Over 5 million of investable assets that they want to put away and have grow tax deferred, maybe even take advantage of some tax-free growth if structured correctly in the non-modified endowment contract, but still over time have the same access to that capital as they might in their traditional investment account, just taking withdrawals of the principal and loans and having those structured. So really taking advantage of the tax code again, with what's very black and white in that code, and having your investment portfolio, instead of subject to capital gains, dividend taxes, now potentially could be tax deferred, tax free. Is that very quick version of a summary of where this might fit?
It is, and the type of client that this works for best, as I mentioned, this has been utilized by ultra high net worth families for decades. It's really, we use the expression shelf money. It's money that clients are putting away and they're not looking to touch it tomorrow. Yes, they can access it anytime if they need to, but they want to take advantage of that tax deferral, the tax compounding. Most of what we see, probably 99.9% of these, are done as part of an estate planning strategy where there are trusts involved. So, they've moved assets into trusts for the benefit of, the spouse, the second generation, the grandchildren, let's say, the third generation, and they want to take advantage of that tax compounding.
Yeah, it sounds like a great tool if a business owner is about to complete the transaction of a sale, so that money that's already been taxed potentially, or that's inside of a trust on some planning they'd already done, and now to have that money potentially never be taxed again if done right, or some sort of found money, inheritance, other things like that, where are able to basically set aside that money for the future, where it may not have any future taxes associated with it.
Correct.
Great. So what are some of the pitfalls though? What sounds like such a perfect vehicle if you've got, that level of wealth, it seems like a pretty perfect strategy. What are some of the pitfalls or mistakes that you see investors and advisors make when considering private placement life insurance or annuities?
Well, that's a great question. And I know I've said this a few times, this has been around for years, but in the more recent years, I've seen that this technique is being offered to clients that might necessarily not belong in the product. That's one thing. The mistakes that I see being made, one being on, as I mentioned, the investor control. It's something called the investor control doctrine, where if a client violates that, they lose all the tax benefits afforded to life insurance. And there was a case a few years back, the Weber case, it's Weber v. Commissioner, where an individual blatantly just violated the investor control doctrine by telling the investment manager where to invest, what companies to buy into, what companies to sell. It was just something like 75,000 emails back and forth the service uncovered, and they lost all the tax benefits afforded to the policy.
Yeah.
I mean, they're taking a good thing and they're just trying to, and it gets abused. Another thing that I see is, and this is what's been more disturbing, is you've got practitioners going to clients and saying, if you're going to sell your business, let's structure this and put part of your business inside the policy before it's sold. So let's say a client's going to sell their business for, well, I'm just giving an example, $25 million, and the value of the business currently is $5 million. That somehow winds up in the insurance policy. The business is sold. All of that gain stays inside the policy as the tax deferred asset. And then they start to borrow the premiums out. It's just there's so many things with that that are troubling, because if you're running your business, I'm not sure how you're getting around the control issue. That's one thing. So I'm just seeing a lot of practitioners push the envelope and bringing these type of strategies that they shouldn't be utilizing to clients who don't know any better. And I think that's going to cause a problem for the transactions that are being done correctly.
Great. So great tips and ideas and things to be looking out for as you might consider this. So, from our conversation, it sounds like private placement life insurance, if you can avoid those pitfalls and mistakes, is a great potential tool. If you have at least 5 million of investable assets, but really to your point, probably 10 million or more of investable assets, life insurance need, want to take advantage of some of the benefits of life insurance and the tax deferral, tax-free nature of it, this could be a perfect solution for you. So if you think that this might be something that could benefit you, I'd love to talk with you more about our offerings and how we might be able to take a look at your overall situation and really see if this might be a fit. So send me an email, homer@convergentwealth.com, if you got any questions around this or any of the other topics that we've been discussing with Frank. And I'd love to dive into your situation and see if this might be a fit. So with that, Frank, thanks again for joining us on Advance Your Wealth and this time around private placement life insurance, and look forward to talking with you again here in the near future about some other advanced planning topics.
Thank you for having me.